to our options education webinar series. My name is Tony Zhang. I'm the Chief Strategy Officer here at Options Play, and I am joined here by Jessica Inskip, our Director of Education, on here what is arguably one of the most important topics for options traders, which is understanding the fundamental building blocks of options trading, the call option and the put option. We're going to take some time here today and dive into the basics of these types of contracts, what they mean, and also go through some scenario analysis so that you can really understand how they perform when the trade goes in the direction that you expect it to, what the risks are if the trade doesn't go in the direction that you expect it to, so that you can better understand how to utilize these strategies for your portfolio and how to go about selecting the appropriate strike prices for buying a call or a put option. So with that, let's go ahead and get started. And Jessica, welcome, and thank you so much for joining us today.
Yeah, thank you so much for having me, Tony. All right, so let's go ahead and get started. Like Tony said, this is arguably a really important subject, so happy to take you through it. As always, we're going to start off with an important disclaimer. Types of securities firms and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or solicitation or an offer to buy or sell any securities. And this video is not intended to be used for individual tax, legal, or investment planning advice. So what we're going to cover today is we're going to do a review of the calls and puts basics. We're going to look at an option chain, so where you would look for the prices on an option chain, the way that it's comprised and the anatomy of it, and then all of the tools and resources to help you put that together. Then we'll look at the long and short side of equity calls, and we're going to spend a lot of time on the equity calls because everything's really a mirror image, and this is a basic presentation that will give you the skills. So if you know the long equity call really well, you can mirror everything else, and I'll explain that in more detail with some visualization. Then we'll talk about the long and short equity puts. We'll put it all together as far as everything, what it means and the tools and resources that you have in first trade. And of course, we'll save some time for Q&A at the end. This is a longer presentation, but like I said, we're going to teach you all the tools and resources that you need to be able to put everything together in a comprehensive manner. So let's go ahead and dive in. So first, I'm going to just show you this T-chart. It's something Tony and I have shared with you probably multiple times, and you can see a lot with the content that we create. And it's something, honestly, that I learned back when I was taking my Series 7 on how to understand the way that options work. So this is what I'm saying, how everything is a mirror image. So if you haven't seen this T-chart before, let me give you a brief explanation. Long calls and short puts are at the top. So this top quadrant is anything that is bullish, and short calls and long puts are at the bottom. So the bottom is anything that's bearish. Long calls and long puts the calls are on the left, and then the puts are on the right. And you can see what's in common is the mirror image that everything has. So for a long call, it contains the right to buy. You own a long call. You're the buyer in that situation. A short put is an obligation that contains the obligation to buy. So if someone exercises the contracts, if you're on the short side, you're obligated to fulfill those terms of the contracts. But without going into the details, what I want you to see from this quadrant is anything that's bullish either has an ownership or a right to buy or an obligation to buy, and anything that's bearish individually has an obligation to sell or the right to sell. So that's something to keep in mind. That's extremely important when you're really learning about options. But like I said, we're going to focus on long calls, and you can utilize this to see everything as a mirror image. Everything is really the opposite when you flip across. So let's go to an option chain real quick. And this is something where we pulled the screenshot before the Fed announcement, so know that nothing's up to date now. But on an option chain on First Trade's website, and generally on options chains, the calls are on the left-hand side, puts are found on the right-hand side. The strike price is in the middle. So the strike price is the agreed upon price for the terms of the contract. The expirations are listed here sorry, this is moved down, and here as well. And with first trades, you can move over kind of like a timeline and click the expiration, and they'll collapse and expand on the bottom. And then you can adjust with settings here as well. The last price, so this is where I just want you to understand what the prices actually mean. So the last price is simply the last price that it was traded at. So if you have something that's a little bit illiquid, meaning it hasn't traded in a while, it may show a last price, but that could have been a week ago, or it could have been a second ago. The last price is just literally, this is the last time it traded, that's in the past. The change is just the difference from the last and the previous close. So sometimes you may see that as 0. That's because it's been a while if there's an illiquid option, so something with not a lot of volume, but this is Apple that we're looking at. And for this example, and that tends to be fairly liquid. The bid is the best price available to sell. So if you were selling, generally the market equivalent on a stock or an option would be executing right on the bid from the seller's perspective. So that's what the bid represents. And then the ask is the best price available for you to buy. So as the retail investor, we buy on the ask and we sell on the bid. So if you see a last price, that perhaps it was from a while ago, so if we're looking at something farther out or super deep in the money, when options get a little illiquid, you may see a difference between the bid and ask and the last price, which is almost a little prevalent here. And here the last price is 58 cents, but if you actually wanted to buy the option, it would be at 60 cents. And if you wanted to sell it at 59 cents, which is not indicative of the last price. So that's one way to look at liquidity and things of that nature, and we'll tell you some tools to help you with that. Volume is updated intraday. And that's important to know. So throughout the day, this is how much is actually traded today. That updates as trades happen real time. Open interest or interest on First Trade's platform is just the amount of contracts that are in existence, and that updates on a daily basis. So for example, volume is there's a buyer and seller, and then we don't know if they're opening or closing. And at the end of the day, everything is calculated to show you how many contracts are actually in existence. And that's another gauge of liquidity, is how much contracts actually exist, how much have been traded today. And that's where I want to show you how to access the options play tool, which is via right here, the options play wizard. And I'll hand it over to Tony real quick to walk you through exactly what's available for you. But it's important to know the components of an option chain, where you look for liquidity, how things work. But really the beauty of options play, really simplifying what you're looking at.
Yeah, thank you so much, Jess, for giving us that walkthrough of the options chain. And I know for traders who are familiar with trading options, it is certainly a place that you start wherever you do your research. And for those of you that are brand new to options or just starting to learn options, you might find this page a little overwhelming simply because there are so many possibilities. You have different expiration dates, you have different strike prices, and you have a lot of different data points within those strike prices to help you pick a specific starting point. So just a quick check with the audience. Please bring up your chat window. How many of you find this page a bit overwhelming or confusing? Whether you're an experienced or you are new to options trading, how many of you find this page somewhat overwhelming? Please type yes into the chat window if you find this sometimes a little too much, if you will. And I see a lot of yeses. And this page is useful because it tells you what all the possibilities are. However, it's hard to know where to start. And that's really why we built Options Play. And you can access Options Play through your platform by clicking on the Options Wizard screen that shows up here on your page. And when you click on the Options Wizard page, it'll bring up Options Play, which you will be able to see it in your First Trade platform. Now, this platform was designed to help you navigate the options chains and give you a starting point that is better than using the options chain, meaning it gives you strike prices and expiration dates that follow the best practices of what we teach in terms of how to utilize these strategies, and then giving you those starting points so that you can quickly analyze and decide which one of these strategies is best suited for you. So when you launch the options play platform, in the middle is your security analysis panel. So Jessica was looking at Apple here before. Whether you have a bullish or bearish view on Apple, there are buttons here at the very bottom of your platform that allow you to select whether you're bullish or bearish, and the platform will automatically select calls or puts depending on your directional view. And we're going to spend a little bit of time here today to walk you through what a call option is, what a put option is, and when to utilize those strategies. But once you learn them, the platform actually helps you automate the process. So if you're bullish on Apple, looking at the August 135 call option is a good starting point for if you're bullish on this particular stock. So it picks the expiration date and strike price for you. And if you're bearish, it'll also pick the expiration date and strike price for you so that you can get a sense for where do you want to start if you're buying puts, if you have a bearish view here on Apple. So this platform is designed to, again, help you navigate the chains and give you a starting point as opposed to simply using the options chain and having to pick yourself. Many times the data points on the options chain isn't even enough to help you pick the right starting point. So our platform analyzes volatility, analyzes all of the underlying data points that a trader would need to decide what strike price to use as a starting point, and then presents it to you so that you don't have to use that options chain and do that manual work and still have some interesting information such as, and Jess is going to walk you through some of the scenario analysis here in a minute, but if let's say Apple's currently trading at 135 and you're bullish on the stock and you think the stock might rally up to, let's say, $150, you can type that in and actually see how this August 135 call option would perform if the stock does rally from its current 135 up to the $150 range. And you can type in any scenario analysis and quickly get a sense for what the starting point, meaning what is the strike price and expiration date to start with, and what is your potential reward if you are correct on your directional view, and more importantly, what would you lose if the trade doesn't go in your favor. So you can see how much you can potentially lose, how much you can potentially make, and quickly get a sense for risk and reward before you click on the trade button for execution in your first trade account. So with that, what I'll do is I'll pass this back to Jess, and I'm going to come back after she introduces calls and puts to you with some specific examples and show you how you can take what you've learned here today and apply it using the options play platform.
Oh, thank you, Tony. All right, so let's talk about long equity calls. And remember, I'm going to go through long equity calls in more detail, and then we're going to look at the various scenarios so you can understand it and get that good foundational element ready to go. And then we'll shift over to puts, but we're going to spend a lot more time on long equity calls. So the example that I'm using actually is real prices, and that's why it occurred in the past, but we're looking at a long call. So if I were to have a long equity call, I would enter into the trade as buying to open one Apple call expiring on April 22nd. Let's assume that's 30 days from now, and it's a strike price of 150. So again, it was real prices. Apple is not at 150 anymore, but it was at one point when this was taken. And that's for a premium of $7. And what that represents is I own the right to buy 100 shares of Apple for $150 per share at any time until April 22nd. Through the duration that contract exists. And in exchange for that right, I paid a total debit of $7, which is quoted per share. So the multiplier, one contract generally represents 100 shares. That means that I paid a total of $700 for this right. Now, options have a finite life. There is a decaying aspect to it, because there is an expiration period. And so what that simply means is, since I have the right to buy at 150, I want that to be worth as much as possible, which means this is a largely directional play. I need Apple to go up as much as possible before the expiration date. And in addition to that, I need it to go up more than the time or the extrinsic value that I paid for that option, which in this case is $7. So for example, as options decay or as they get closer to their expiration, they start only pricing in intrinsic value, which really means the actual value that the execution terms of the contract contain. So for example, if Apple was at $160 per share, this contract should be worth at least $10 per share, because I would own the right to buy at 150, could sell at the market at 160. So that difference of $10 is considered its intrinsic value. Anything excess of that is its extrinsic value. And normally that's made up of time. So the more time we have until expiration, the more time it is that the underlying can move above or below our strike, therefore it's more expensive. And then also anticipated market movements can make it more expensive as well. But those tend to be decaying factors, and that's what we have to take into account when we're trading long equity options, is we need the stock to move actually more than what the extrinsic value that we purchase, which is depicted on this profit and loss diagram. So the strike price is 150. We paid $7 for it. So that's where we actually break even at expiration, because if the Apple was at 157, we know it would lose all of its extrinsic value, but I to buy at 150, could sell at the market at 157. Therefore, that's worth $7. That's why we need it to move more. And then we have unlimited gain potential, because Apple can go to an infinite price. And if we own that right to buy during this time frame, however high Apple goes, our option should go up in value as well. But that extrinsic value component is why the stock doesn't move dollar for dollar, which we'll talk about when we go through actual examples. So this is important to understand here. And really the main takeaway from showing you this is anytime you're buying an option, you're long the option, there is more to the option than purely what the contract is worth, that in the money or intrinsic value. There's this extrinsic value component or time value component that you have to overcome in order for it to be profitable. All right. So that shifts over to the short equity call side. So if you were on the other side of this trade, instead of buying to open, your opening transaction would be a sell. So you'd be writing the call, and then it's the same from there. You'd sell to open one Apple call expiring on April 22nd. And again, let's assume that's 30 days from now at a strike price of 150 for a premium of $7. So instead of paying $7 in order to have the right to buy, you're actually receiving $7 per share, or 700 total, for the obligation to sell. You are obligated to sell the shares at the strike at the long holder's discretion. Oftentimes I use this analogy, and you've probably heard it from me quite a bit, but the way that I like to look at a long and a short option holder is through the eyes of someone driving the car. The long option holder is the driver. They make the decisions. It's ultimately their choice if they're going to hit the brakes and stop or turn left or right. The short equity call holder, the short option holder, they're the passenger. They can get an idea if the stop sign's coming up, or understand if the long option holder is going to go left or right, but ultimately it's the long option holder's decisions, and they're kind of obligated to go with them because they're strapped into the car. And that's the way that the short option works, though. You have the obligation, not the right, and your obligation is to fulfill the terms of the contract in which it contains. And for a call, it's the right to buy. For the put, it's the right to sell. So it's really the inverse is true, and you'll notice all of the calculations are essentially the same. The short equity call holder has limited gain potential. Their gain potential is actually limited to the premium that they received. They have unlimited loss potential because they're required to sell the shares at the strike. If Apple were to go to that extreme circumstance, say $250 or $200, well, if they don't own a long offsetting position, which is something that contains the right to buy Apple, or 100 shares of Apple, that's how they face unlimited risk potential, because that could kick in at any time at the driver's discretion. So if Apple were to go to 200 per share, they would have to buy it at the market for 200, sell at 150. That's a $50 per share loss. So that's why there's unlimited gain potential for the long option holder. They need to overcome that time factor, that extrinsic value factor. There's limited gain potential for the short equity call holder because they're keeping that premium, but they have unlimited, and that time factor will work in their favor because they want to buy back at a lower price. So that decaying is good for the short option holder, but they have unlimited loss potential because of that obligation that is inherent of the short equity call. So those two concepts are extremely important to understand before we move on. We'd really appreciate it if you just type a yes in the chat if you get that. If not, we'll spend a little more time talking about it.
Yeah, and while everyone answers this, I just want to reiterate how important this is from a foundational perspective, meaning understanding the four quadrants, the T chart that Jess is referring to: long call, short call, long put, and we're going to cover long put and short put. But just remember that these strategies in itself may not necessarily be strategies that you trade exclusively, meaning you may never outright short a call option because of that unlimited loss potential. But the reason that it's really important for you to understand it is because they are used in strategies. So you can actually use a combination of these long call and short calls in a single strategy that kind of provide a bit of benefit of the best of both worlds, if you will, because each of these strategies have what we would call trade-offs. When you're buying a call option, the benefit is that you have limited risk with unlimited profit potential. Doesn't that sound great when you can effectively leverage your capital and have unlimited gains if you are correct, but have limited downside if you're wrong? You know, we usually think of leverage as a double-edged sword, but you know, buying a call option truly does give you leverage to the upside, but limited downside if you're wrong. Vice versa, if you're short a call option, you have limited potential gains, but you have unlimited loss potential. And a lot of people will say, why would I ever take a position that has limited gains and unlimited losses? Well, the reason is because you have a higher probability of profit. You're profitable as long as the stock stays where it is, moves in the direction that you expect it to, or even if the stock goes in the opposite direction that you expect it to, you can still be profitable. You know, that's something that's attractive to a lot of traders. So, but however, you know, the unlimited loss potential may be enough of a reason for you not to trade these. But, you know, as you learn more about options trading, you're going to see how you can actually combine these two strategies together and get what we call the best of both worlds using vertical spreads, debit spreads, credit spreads. Some of you may have even traded some of those strategies. We have a report that you can access here at Options Play that allows you to trade these types of strategies. Or if you're just selling a put or a call option, you might be selling a cover call or a short put. I'll show you some of the reports that are available to you here at First Trade that allow you to leverage these strategies. But however, in order to understand those strategies, you have to first understand the fundamental building blocks. And that's what we are hoping to teach you here today.
Well said. All right, so let's go through an example of what would happen through the eyes of the long call purchaser and the short call writer. So you can see what that trade-off is. So we've got the same trade here, but just looking at it from the purchase of buying and selling. So the person who is purchasing the call, they're bullish. They want Apple to go up as much as possible. The short call writer is it's not directionally too bearish, but it's actually neutral to bearish. And notice there's price targets here as well. So the short call writer thinks that Apple's going to stay the same in this case, but the long call purchaser feels that Apple's going to perhaps go to 165, and they both have a 30-day time frame. So that's where this chart on the left-hand side is important here. This is when the trade's placed. Apple is at 150, which means that they purchased or wrote a at the money call. That's where the call is right now. And the purchaser paid a premium of $7. So they're already out of pocket for $7 and they have the right to buy. The seller has received that premium of $700. So we'll see what happens with each outcome. And then what's important to know, because the Apple trade or the long call holder only profits when the stock goes up, but it needs to go up more, at least at expiration, than what the premium that they paid. So that's $7 break even. Losses begin for the short call writer actually at the same place when that obligation kicks in. So that's important to see the trade-offs. And like Tony said, you can layer these together to get the best of both worlds. But for the foundation, it's important to know how these play out in various scenarios, which I'll take you through. So let's say it's day 15. And this is important to look at prior to expiration and at expiration because of that time value component. So Apple's at 165. So that means that the contracts are at 17. That's great for the long call holder because it rallied more than that $7, which is what we were looking for. But remember that time value component is there. So that's why the price is what it is. And say both decided to close in this scenario. This is where it's that risk profile, if you will. There was a gain of $10 total for the long option holder and a loss of $10 per share, 1,000 total, excuse me, for the short call writer in this case. The long option holder could potentially hold on to this if they didn't close it and capitalize on more upwards movement. However, any extrinsic value that's remaining will actually be decaying, which in this case is $2 per share. Because remember, if Apple is at 165, and I have the right to buy at 150, but the market's at 165, that's at least $15 worth of value. This option is $17, so it's got $2 left of extrinsic value. That $5 that we had has already decayed, and we've got $2 left for it to decay. That's going to benefit the short call writer and hurt the long call purchaser, and that's important to know from this example. So let's look at day 30. So Apple moved up $1, but that wasn't enough. There's still a gain on the long call purchaser, but they lost out on $100, but that helps the short call writer. So that helps reiterate the example there. There was that $2 of extrinsic value on day 15. That decayed as we got to expiration, because now at expiration, our options should only be worth their actual executable terms or their intrinsic value, that are in the money value. There are lots of ways to say that, but it's essentially what the right contains. So right to buy at 150, we can sell the market at 166. That's at least value of $16 or $1,600 total. So there's a gain of $900 on the long call purchaser. They lost that $1 because of the $2 decay. And then same with the short call writer, that actually helped them in this scenario because they benefit from time decay.
And if you don't mind, Jessica, I just want to jump in here real quick, because we've seen a lot of traders buy call options expecting that they would make money if the stock goes in the direction they expected to, such as in the example that you've shown here. But how many of you have bought a call option, saw the stock go in the direction that you expected to, and then still had a loss on the call option? Please type 1 into the chat window if you've ever experienced that, where you've learned that buying calls are going to generate profits if the stock goes higher, because you're certainly used to, if you buy the stock and the stock goes higher, you make a profit. But if you ever bought a call or a put, had the trade go in the direction that you expected to, but still lost money on the trade, please type 1 into the chat window. I see a few ones here, and this is really where, if you see that break-even price, the fact that you had to pay $7 for this call option, if the stock didn't go all the way up to 166, as Jess is showing you in this particular example, maybe the stock goes up to $155. It went up $5 from the time that you bought the call option. But because you paid $7 for a call option that's only worth $5 at expiration, because the intrinsic value of an option that's trading a 150 call option when the stock's trading at 155 is only going to be $5, because you can buy the stock at 150 and you can sell it on the open market for 155. Yes, that will net you $500 worth of profits. But remember, you paid $700 to get into the trade. So if you can only make $500 versus paying $700 out of the pocket to get into it, then you've lost $200 in the trade. So this is really the important part of being long a call option, is that you have to factor into not just saying that I think the stock's going to go higher, but understanding what is the break-even price of the option that you've purchased, and whether or not you believe the stock is going to rally above that specific price. So, and you know your break-even price at the time you enter your call option. So when you buy the $150 call option for $7, you know at the time of trade entry that the break-even price is $157. So the question you want to ask yourself the next time you buy any call options or put options is, what is the break-even price? And do I think the stock is going to exceed that specific price? If the answer is yes, then this is a trade perhaps worth taking a look at. But if, let's say, you look at a call option that has a break-even price of $157 and you don't think the stock is going to reach that price, well, that should probably be a call option that you do not purchase. So it's really important to understand that break-even price and how that factors into your decision-making process as to whether or not you buy that call option. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Perfect. Okay, I see a lot of 2s. So Jess, thank you so much, and let's move on to the next slide.
Yep. All right, so now let's look at not breaking even or rallying, but the other way. So the stock declines. So, and in this case, actually stays the same. So Apple is at 150, 15 days later. The max loss, remember, for our option for the long call purchaser is the premium that we paid, $700 total. But since the stock didn't move and we still have 2 weeks roughly left until expiration, that means we have some time value left. So building on with what Tony was saying is, if things don't go your way, and as the long option holder, that time decay component, or that break-even piece, or that anything in excess of the actual value of the contract is going to decay over time, but we still have some time value left into this option, which means we could mitigate our losses at this point if the option or the underlying security continues to move against us. So in this case, because there's time value left in the option, and it's actually centered around at the money options, that's why it's higher than the previous example, we could close this option for $5, cut our losses, and we've got some best practices for options we can share with you. And we could cut our losses. Instead of losing $700, we would have lost $200 in this example, because we can sell to close our option for that time value component. Now, on the other hand, for the short call writer, time is in their favor. So that even though the stock didn't move, we're still on their price target within their time frame. And therefore, since that $2 of extrinsic value has depleted, they can buy back for $5 and make a gain of $200 in this case. So you can see the differences there of time if the stock doesn't move at all. And these were real prices at a snapshot in time. So that's an important component. So let's see what happens if we go all the way to the day of expiration. So say now it moved down to 145. Well, the option is going to be worthless because I have the right to buy at 150. And if the market's at 145, the option isn't worth any value whatsoever. I can go ahead and buy at a cheaper price at the market. And therefore, they're going to be a little illiquid and expire worthless from your account. That's going to put me at an entirely full loss for the long call purchaser. And I'll be at my maximum gain as the short call writer, because I do want the option to go down in value. And I benefit as it goes down in value, or if it stays the same. So the important piece of this is just to look at the component of time and understand that time really favors the short option writer, and is something that you have to be cognizant of if you are long options. All right. Anything else you want to add, Tony, before we go to puts?
No, I think just understanding that call buyers and call sellers are on the opposite end of each other is really kind of the important part here. So between the buyer and the seller, it is a zero-sum game. However, a lot of traders have this misconception that if I'm a buyer, then someone, or if I make a profit, someone is at a loss, or vice versa. If someone's at a loss, if I lose money, someone else is profiting from that. And that couldn't be further from the truth. We don't quite have enough time to dive into just how the other side, meaning how does a market maker actually hedge their risk on the other end. But it's not true, because when you're looking at a slide like this, does seem like it's a zero-sum game, that, if I place a trade and the market maker's on the other side, they have an incentive for me to lose money. And that couldn't be further from the truth, because the market maker, once they are on the other side of the trade, they will hedge their trade. So it doesn't really matter whether you make money or lose money. They largely have hedged their risk. So just important concept to understand, so there's no misconceptions that you are making money or losing money because someone else is on the other side of the trade.
Great point. All right, so now we're on the other side, and this is where we like to spend a lot of time with the long equity calls and the call side of it, really, because once you understand that, utilizing that T chart, you'll notice how everything is a mirror. So you notice the mirror from the long call to the short call, and now we're going to go to the long put and then the short put. So everything is really a mirror, and once you really know a long equity call, you can kind of figure everything else out. So we'll go through this one fairly quickly, and then we'll go over some tools and resources as well. But it's really the opposite. A long equity put contains the right to sell. So in this case, your opening transaction would be buying one Apple put, expiring on April 22nd at a strike price of $150 for $7. That's a premium that you're going to pay because you are buying the right to sell 100 shares of Apple at $150. And you have that right at any time. You're the driver in this situation because you're the person who purchased the right. You do have substantial gain potential, not unlimited gain potential. And that's because the stock can only go to zero and not an infinite price in this point. And the same is true for the long equity put holder as it is for the long equity call holder, which is that time value component. So you'll notice instead of having to overcome the greater side of 157, now it's just on the downward side. So now we just have to overcome 143. And that's at expiration, but it's taking into account your break-even point and where you feel the stock is going to head within your expiration period, and preferably before your expiration period, additionally, because you want to recapture or recoup any time value that you purchased as well. And that's why this is a bearish transaction. And that's something I failed to explain in the beginning, but I apologize. But with these profit and loss diagrams, I hope it's fairly obvious. And it's good for a visual representation if something's bullish or bearish as you layer these together in the way that it flips. But anything that generally moves in this direction, so the stock going down, it's profitable when the stock goes down, and then not profitable as the stock goes up. So that's how you would visualize that. So looking at the short equity put, so this is a bullish strategy because now it contains the obligation to purchase the shares. So remember, anything that just has the ability to purchase of some sort is generally a bullish strategy if it's the driver of the situation. So just like with the call side, remember it's a mirror relationship. The long equity put holder has the right to sell. Now I have the obligation to buy from them if they choose to initiate that sell. Therefore, I don't want the stock to go down. I do not want the long equity put holder to initiate their rights or execute upon those terms. Therefore, I want the stock to go in the opposite direction. And so this is bullish. If the stock does go down, we have the same break-even point, and we don't have unlimited loss potential, but we actually have substantial loss potential, because if the stock does move down and they want to execute upon those terms, I would have to buy at the strike, which is going to be at a less favorable price in the market, in which case there are losses as the stock goes down. So it's important to really understand this one as well. A lot of times short equity puts are utilized to purchase stocks and things of that nature. And there's lots of ways to utilize this strategy, but there is substantial loss potential because of it contains the obligation to buy. So we'll go through the same scenario here, and I'll give you their sentiment and price target and time frame. And that's extremely important, and a great takeaway from this presentation is just knowing how you feel about an underlying security, especially with this type of market. Having a price target in mind and a time frame is really important. So the buyer pays a premium of $700. Remember, they needed to overcome that premium. The break even now is lower at this point, and they have 30 days to be profitable. So the person purchasing the long put would like Apple to go below 143, preferably before the 30-day time frame is up so they can recoup some of that time value that they purchased. The short put writer, in this case, they're neutral to bullish. They're okay if Apple stays the same. They're still going to be profitable in that scenario, but they do want Apple to go up because then that's where they're going to realize their max profit, which is the premium that they received of $700 total. And then we'll go through those scenarios as well. So let's say Apple did go down, and this happened within the 15-day time frame. So Apple's at 140. So I have the right to sell at 150. So that means I could buy at 140, execute on my terms and sell at 150. That should be worth at least $10. That excess $1 is that extrinsic value component that's going to decay. And remember, that's going to hurt me as the long option holder, something I could recoup if I sell to close now, and help me as the short option writer because that decaying asset will allow me to buy it back at a lower price. So in this scenario, if we were to close out our options and realize the gain or loss, the long option holder would make $400 and the short would lose $400. All right, and let's go to expiration day. So Apple went down to 135 in this case. Now it's purely worth extrinsic value. We did overcome our break-even point, so went lower than 143. We collected $15, which is just purely the intrinsic value of the option. So we captured that as the long put purchaser, paid that premium buy to close for the short put writer. So there's a gain of $8 for the long put purchaser because it did go down and moved in our favor beyond the break even, and it hurt us as the short put writer. And then we'll go through one more scenario. So now we have Apple at 143, which is right at our break even point. Now, this is before expiration, and there is an interesting component that could have happened here, and this is what I need everyone to be cognizant of when this does is like just how things can be a little more expensive on the put side versus the call side, and that's why you might see a variation of prices versus the example that we saw on the equity call. So just something to think about. So in this case, because it's at the money, right at the break even, I can receive $9 if I sell to close this, and I would pay $9 on the short put side. So there is a gain of $2 here and a loss of $2 on the short put side. And we got right to our break even, but remember, time value is still a component of this trade. And so say we went all the way to expiration. Now we're right at break even. The option is only worth our extrinsic value. That time value component depleted, that $2 that we actually had left, which means now we broke even. I wasn't able to recoup that. So that's a really important lesson there is it didn't overcome our break-even price quick enough within that 15-day period, and it actually stayed the same. So if it doesn't have enough velocity, that's a great way to capitalize on some time value that's left if you feel that downward momentum in this case has been exhausted. That's something that is just important to note, and I think a really good lesson here to take away. But because we did hold on to our option in hope that it would go down more or perhaps up more as the short put writer, both broke even in this case.
So thank you so much for running us through those different scenarios. What I want to do now is run you through how to use the options play platform to do similar type of analysis, but using real world examples of trades that you might actually make. And I'm going to use Apple here again as our example using the options play platform. And I'm going to use a bearish example here for Apple, or rather, let's take a look at a bullish view. Perhaps you're looking at the Fed today and you're saying the Fed is doing the right thing. They are They've increased the hikes to 75 basis points to fight off inflation. They're leaving another 50 to 75 basis points open for July. So this certainly seems to be the market, the reaction that the market was looking for. And the market certainly seems to be, responding to this fairly positively, at least from the price action we've seen after the Fed's announcement. So maybe you think now is a buying opportunity for some of these beaten down stocks like Apple. So when you pull up Apple here using options play and you select bullish, you might see that you could use the August 135 call option as a starting point for buying calls. And the reason that we're selected the 135 call option is because the current price of the stock is around 135. And as you can see here, the cost of that call option is $9 or $900 for every contract. So it's important to understand the break-even price of this strategy. $135 plus the $9 that you spend will give you a break-even price of $144. So the options play platform calculates this break-even price for you so that you can ask yourself, do I think Apple will be above $144 by the August expiration? If I do, this might be a trade that I want to trade. Otherwise, this is probably a call option that's a bit too expensive. And the more expensive a call option is, the further the break even is away from the current price. So just to put that into context, if we look at a chart, $144 is about right here or so. Right here, let me just draw a line here. 144. So perhaps you think on a bounce, we're going to get back above $144. Maybe you think we'll get back to 150, maybe 151, the recent highs that we saw here. So this is really where you can use the P&L simulator and simulate what happens if Apple returns back to 151 at the expiration date. How much can you potentially make on this particular strategy versus if you outright bought the stock? An 11.5% return if you bought the stock, a 77% return if you had bought the call option. And then you can also ask yourself, what happens if I'm wrong? What happens if this market continues to decline? What if Apple stock goes back to 115? If you had bought 100 shares of the stock, you're looking at about a $2,000 loss versus only a $900 loss by buying the call option. And this is really where the limited risk factor of the call option kicks in. You are limiting your losses to the downside while leveraging your capital here to the upside. And the options play platform gives you the starting points to help you understand which calls and puts to start looking at if you have a bullish or bearish view, and then using the P&L simulator to quickly understand your potential risks versus your potential rewards to decide, is this a trade you want to make? Perhaps you look at a chart here and you say to yourself, even on a bounce, I think it's only going to hit $140. Well, you're going to see that even in a best case scenario, you're going to take a loss on this call option. So that might be a call option that you might stay away from. And this is how you can decide whether this is a call option that you want to purchase or not for your portfolio. And if you are in the camp of believing that the markets are going to rally from here, you think Apple could get back to maybe 150, 152 or so, and you want to buy this call option. This is really where the integration between options play and first trade, simply by clicking on the trade button, it will give you the details of the trade, and you can hit the preview order button here on the lower right-hand corner. And when you click on preview order, it will actually fill in the order ticket for you. So I'll have a single contract of the August. I'm not sure why this, the strike price is not showing up right here, but that will pre-fill the order ticket for you in the order ticket so that you can send this off for execution. Currently, there seems to be an issue with the strike selection here on first trade, but I'm sure we'll get that sorted out. But this will pre-fill the order ticket for you so that you can send this trade for execution without having to bring up that options chain, search for these August 135 call options before you place your order for this particular trade. And it also pre-fills the order price for you, the $9 for this call option, so that you can send this off for execution as quickly as possible after you've taken the time to analyze it. And you can launch options play again using the options wizard link here on your trading screen when you click on options, or if you're on the home screen, you will also see a link here for the options wizard, which is on the lower right hand corner. So with that, that covers what we wanted to share with you here today. Thank you so much for your time this afternoon. I really hope that this was helpful in giving you a better understanding of the basic foundations of option strategies, which are calls and puts, and the difference between buying calls and puts and the difference between selling calls and puts. So with that, thank you so much. What we'll do is we'll open this up for Q&A. If you have any questions, we'll try to answer a few questions before we sign off here for today. There's both a Q&A section and a chat section at the bottom of your screen. So please type your questions into the Q&A section, and I will try to answer as many questions as possible before we sign off here today.
There is one on a short put assignment before expiration, avoiding early assignment and what factors to look out for. So remember just thinking about the analogy of the driver and the passenger. So you can be assigned early if you hold a short equity put because you contain that obligation. And just remember, if it has purely intrinsic value, your likelihood of assignment is highly probable. I think that's the best way to look at it. We did do a very in-depth presentation on exercise and assignment that's available on First Trade. I know it's on their YouTube account, and perhaps they could give you a link as well. But we do have some details on that. But yes, you can be assigned early, and the best way to avoid that, honestly, is not to hold options until expiration, to have an exit strategy and really utilize those best practices.
If you want a copy of the presentation, you can send us an email at info@optionsplay.com, and we can send you a copy of the presentation. Actually, sorry, I can actually upload, if I'm not mistaken, the file here. Nope, sorry, we can't upload a file. You can send us an email at info@optionsplay.com, and we'll send you a copy of this file. There's a question about asking the recording of the class. Yes, all of the recordings are available on the First Trade website. So if you go to firsttrade.com, you go to research and tools, and you go down to the options wizard. All of our recordings are here towards the bottom of your page. You have all of the recordings here at the bottom of the research and tools and options wizard here at the bottom. Jess, there's a question on the poor man's cover call. I don't know if you want to take that one.
Sure. Yeah, we did an in-depth presentation on that one, which we haven't done with First Trade yet. So perhaps we will add that to the queue and ensure that we cover that with you. But yeah, there is definitely some risks associated with it as well. So a poor man's covered call is essentially buying a very deep in the money or relatively deep in the money call to utilize as your long stock, and then selling a call against that on a continuous basis. And like a covered call, but it's considered a poor man's covered call because it's less expensive by buying that deep in the money option. The risk with that is, though, you can hold a stock forever, you cannot hold an option forever. So sometimes there's a little bit of time value component that's involved with it. You have to be a little more strategic with your timing, and it requires some position and portfolio management. That's important as well, but we can definitely go into depth about the best practices on it. But it's definitely a great alternative for a covered call strategy, especially if you're working with those really, really expensive securities. There's just it's really important to know those best practices to properly execute on that.
Right, and there's a question here. When you place an order to sell a call option, do you fill in only the price of the option, or do you change the strike price of the stock as well? So just to be clear, there's no strike price for the stock itself. You only have the strike price for the option. So if you have the correct strike price of the option, you don't have to do anything else other than placing the limit order. The platform does provide a starting point on where your price is going to be on that limit order, but you don't have to change the strike price if you are already happy with the strike. Any other questions? If there are no other questions, I just want to thank everyone for taking the time out here this afternoon. I hope that this was helpful in giving you a better understanding of calls and puts, specifically the difference between buying calls and selling calls and buying puts and selling puts, because they are, like I said, the foundation of all more advanced option strategies, which generally speaking, as you get a little bit more educated on options trading, will be largely what you might end up trading. So understanding these foundations are going to be very instrumental in helping you understand those more complex strategies. And the Options Play platform is designed to help you navigate this, provide you with starting points, provide you with the risk analysis so that you're confident in understanding your risks and rewards before you place that trade. And the integration here with First Trade allows you to simply click on the trade button and execute those trades in your brokerage account. And we will be back here soon to talk about some of those more advanced strategies like debit and credit spreads and show you how to utilize them and some of the new tools that First Trade has that allows you to find those opportunities and execute those trades in your brokerage account. So with that, Jessica, thank you so much for your time this afternoon. And thank you, everyone. I hope you guys have a great trading day.
Thank you.